Welcome everyone to Multifamily Meetup Mondays. I'm your host for tonight. My name is Carlos Di Reynoso. We appreciate you joining us today. Tonight is going to be a very special show. We're extremely excited. Our guest for tonight is Dr. Mike Lorence. We're very happy to have him on the show. Mike has a long repertoire, great person. Let me just tell you a little bit about myself, and then I'm going to jump in and tell you a lot about Mike and what he's got going on as well. So if you're here about multifamily, you want to learn about multifamily. This is basically, I'll tell you about the show. The show started as a in-person meetup, right? So basically we would meet, we would talk multifamily, and we would learn as much as possible, and we would share and we would network. Well, of course, you guys know the pandemic hit, and as soon as it did hit, we went virtual. And so we've been doing this show virtual ever since. Last week, we had someone from Advanta present, last month actually. And the previous month, we had someone from Old Capital Lending who also presented for us. So tonight, we're very excited to have, and thank you guys for joining us today. As I could see, a lot of people are coming in now. So as you're coming in, go ahead and let us know where you're coming from, what city and state. And if you are coming from other countries, which I am expecting some international guests today, please let us know what country you're coming from as well. So as I was saying, this is Multifamily Meetup Mondays. Our guest for today, our honored guest, I really want to say, is Dr. Mike Lorence. Dr. Mike Lorence has a PhD in interviewing high quality potential candidates for high quality jobs and positions in the investment world, if you will. And you'll correct me if I'm wrong about any of this, Mike.
You did a great job, Carlos.
I appreciate that. And as we go on, I'm going to say he was voted top 40 under 40 in North America, a private equity M&A industry, finance and investing expert. Mike Lorence, Dr. Mike Lorence is an award-winning author and wealth strategist with over 250 paid speaking engagements that generated over $2 million in speaking fees. Dr. Mike is a professional speaker and the co-founder of Florida Multifamily Investments. He is also a co-author of Endless, Effortless, Infinite Cash Flow, How to Create Multifamily Mailbox Money for Life from Anywhere in the World Without Ever Lifting a Finger. So I'm really interested to hear about that book as well, Mike. He's also the host of the Florida Multifamily Investment Show podcast with a background in economics, real estate, deal making, and entrepreneurship. Dr. Mike's passion is in educating entrepreneurs how to de-risk their wealth by creating passive income and legally reduces taxes through multifamily real estate without breaking a sweat. He's a transformational keynote deliverer speaker, specifically actionable strategies that can be implemented by the audience immediately. So I'm very happy to have you guys here with us to share with Dr. Mike. I will tell you a brief introduction about this show. So if you're joining us for the first time, this show is basically multifamily at its finest. We're here to network, learn, and after Dr. Mike gives us some more information, we're also going to have breakout sessions so that we could go ahead and network as well. So it's very important that you stick around toward the end because we're going to have some great breakout sessions. And already I'm seeing many professional investors that are here with us today. I'm also seeing people from the mastermind, Dan Hanford's professional mastermind. And I'm also seeing people from Old Capital Lending as well. So I want you guys to know that you're in great company today. So we have investors experienced, new and old, and without further ado, well, briefly, last thing I want to say before we jump into Dr. Mike, which I'm super excited, is that so what I do is I am a co-organizer for Multifamily Investor Nation. If you guys have heard of Dan Hanford, this is his group. I am a co-organizer here in Atlanta, Georgia. And professionally, I am a real estate agent investor. I've invested in the past in, I can't think of the word now, in smaller deals, 5 and 6 units. And so that's what I've done. My experience is 5 and 6 units, originally from Florida, where I invested in multifamily there. And today we're going to be doing, talking a little bit more about what Mike's doing and his professional experience. So without further ado, thank you everyone for joining us. And here's Dr. Mike Lorence with his professional presentation. Take it away, Dr. Mike.
Hey, everybody. Please call me Mike. Thank you so much, Carlos, for setting this up. You've done a really nice job of putting a bunch of really smart people in one place. And we are going to be talking about demographics, but the right title for this presentation really is all about secrets to investing success. And I think the best way to capture what you're going to go through in the next 30 to 40 minutes is a way to evaluate multifamily deals in 3 minutes or less without opening up a spreadsheet. There's a lot of people out there allergic to spreadsheets. So the demographics and some of the concepts we're going to be talking about really don't need a spreadsheet. And I'm going to open up the presentation today by explaining to you that there is a tidal wave of change that is coming to the multifamily investing industry. And I'm going to explain to you that it doesn't really take a rocket scientist to understand the change, because when there was the BlackBerry, that got killed by the iPhone. The cab has been killed by Uber. Hotels are being killed by Airbnb. The American dollar is being trounced by Bitcoin. Customer service agents are being replaced by robots and AI bots. Baby boomers are being replaced by millennials. So this whole concept and process of change that we're going to see coming in the next decade is really something that has two words in common. And the words that you're going to hear me say tonight are two words that create something called creative destruction. And when you talk to PhD economists, they will sometimes use this phrase. And I'm going to use it as sort of the baseline theme for what's going to happen over the next 10 years as it relates to multifamily investing. See, because 2010 through 2020, the decade we just came out of, is going to be radically different for LPs and GPs compared to 2020 to 2030. And so that really brings us to the question that we're going to be answering in this presentation. For investors, whether you are a GP, whether you're an LP, whether you're a broker, whatever role you play in this industry, we need to ask ourselves, how will the last decade, 2010 to 2020, differ from the next decade? And I like to describe it with a little cartoon. This is one of my favorite cartoons. If you can't read it, it's a little girl sitting at a lemonade stand, and her sign at the front says, "One glass of lemonade, $1 million." And the postal guy comes up and is basically going to buy one, and she says, "Yeah, I know it's pricey, but I just got to sell one, and I'm set for life." And that is the concept of supply and demand. See, supply and demand is really the language of economics. And a lot of investors really don't have a great handle on economics, which is why we need to talk about it tonight. When you couple that with the other concept, demographics, which is part of the terminology that was used to promote this event, when you combine the two together, they really tell a very unique picture and give you insights into things that you probably wouldn't have any other way. And see, in the next decade, if you don't understand how demographics and economics are going to affect the multifamily industry, you're probably going to be in the loser category. But then on the good news is there's going to be some winners in this next decade too. And if you can understand who this is for, you can sort of understand what category you're going to be in. So really, this presentation that we're going to go through is really for two main groups of people. Number one, it is for any LP, limited partner, passive investor, who wants to invest in an income-producing multifamily asset over the next decade. If you are a GP, if you syndicate, if you are a sponsor, if you're a KP, if you're actually actively buying assets, obviously this will relate to you too. So we're going to basically break the presentation down into a couple different areas, Carlos. One is we're going to talk about the three most important factors that I think are going to drive returns. And this is not my opinion. I'm going to give you a mountain of data in this presentation. If you haven't broken out your notepad and your pen, you probably want to do that now, or break out Evernote or a Word document, whatever you're going to use to take notes. We're going to go fairly quickly. After that, we'll get into a little bit of an action plan. We'll go through a case study, and then we'll leave Carlos at the end here enough time to do Q&A and break out in some rooms. And of course, it wouldn't be a presentation unless there was a special gift at the end for the listeners. So who the heck am I? I was a poor snot-nosed kid who grew up on a dairy farm in Cumberland County, Pennsylvania. I didn't have any money, raised by my grandparents on this dairy farm. And so that's why I enlisted in the Marine Corps when I was 18 years old. And the Marine Corps had a program back then where they would take the top 2% of enlisted Marines and send them to college on full scholarship. So many years later, I got married to the woman of my dreams. She's here on the call with us. Tricia is my wife. This is probably the most important person in my life. I wouldn't be doing this call without her. And so she definitely has a big influence here on what we're going to be talking about tonight. I have a bachelor's of mechanical engineering from VMI. I got an MBA from Darden and a PhD from Georgia State. And really, I used all that to break into the industry called mergers and acquisitions. And if you've heard of M&A, that is the business of buying and selling companies. Well, interestingly enough, multifamily is effectively the same industry. It's just we buy and sell income-producing real estate. So the principles of mergers and acquisitions actually apply really, really, really well. And 5 years ago, I was awarded the top 40 under 40 award in North America for that industry, and got to go to New York City and the athletic club in Manhattan. If you're a college football fan, the athletic club is where they give out the Heisman Trophy. So that was a really great experience for me. I say all that just to give you a background into where my mindset is coming from when we're talking about these things. Because most of the stuff I'm going to tell you is what private equity and M&A people do when they're trying to size up an investment in any kind of income producing business. As Carlos said a little bit earlier, I got a lot of professional speaking under my belt. Most of the topics I speak on are economics, demographics, taxation, leverage buyouts, leverage recaps, and of course now multifamily. So I'm gonna really kind of give you an opportunity to start taking some notes, because Carlos, we're going to get into the meat here of the presentation, and I'm going to start off with what I like to call the magic formula. The magic formula is E times D equals HI. Now, you probably didn't hear that in 7th grade algebra when you learned algebra from your math teacher. And the reason why you didn't hear this is because this is a very special formula. And this formula really breaks down, and E is economics, D is demographics, and H is happy investors. Now, you'll notice there's a multiplication sign. It's not a plus sign. Economics and demographics create a multiplicative impact on income producing assets. So you really have to look at them both at the same time. And when you combine them, they create a much greater either benefit or problem when you're looking on about investments. And I like to refer to the quote, a very famous professional development guy back in the 1940s, a guy named Clem Stone, created this quote that I like to use in my presentations. And it's the quote of little hinges swing big doors. See, economics and demographics are the little hinges that swing the doors of returns much more so in the next cycle, in the next 10 years. So let's first talk about the economics phase of the presentation. So we'll talk about demographics later. Economics is basically the science of money flows in, out, and through the US. That's macroeconomics. And when you look at the science of money flows in, out, and through the US, it really drives asset pricing. Microeconomics, which is very different, is the science of money flows in, out, and through your city. So obviously microeconomics very, very localized, macroeconomics very, very nationalized. And when you look at the most powerful person in this country who controls the flow of money into, out of, and across the US, who is that? So I'm going to take a quick poll. Drop your vote in the chat. I'm gonna ask you this question: who do you think is the most powerful person in the country right now? Is it Biden? Is it Trump? Is it Pelosi? Is it Mr. Mnuchin, the Secretary of Treasury? Is it Mr. McConnell, the head of the Senate? Or so very quickly, Carlos, we're going to have people drop their vote. Who right now? Who do you think is the most powerful person in the United States? We'll give you 2 or 3 seconds to drop your vote in there. You're either going to vote for Trump, Biden, Pelosi, McConnell, or Secretary of Treasury Mnuchin. Now I can't see the chat right now,
Right, I could
Carlos.
definitely.
Do we have
Yeah,
some votes in there?
yes, sir. I
Okay.
could definitely tell you. We got a few Trumps, a few Bidens,
Okay.
and a few Nuchens. Is that his
Yeah,
name?
I can't really. It's German. Muchen. I don't know.
I got you, Nuchen.
All right.
Yeah,
So the truthful answer is that neither any of these people is the most powerful person in the country right now. The most powerful person in the United States is this guy right here. If you know who this guy is, drop his name in the chat. This gentleman is relatively new in his position. This gentleman is the chairman of the Federal Reserve. His name is Jerome Powell. The reason why Jerome Powell is the single most important person and most powerful person, he's more powerful than Trump. He's going to be more powerful than Biden. He's more powerful than McConnell and Pelosi together. And it's important for you to understand why. First of all, in case you don't know this, the Federal Reserve is a privately held company. It is not, I'm going to repeat, not a government agency.
right.
It is a privately held company, and that means it's, quote, independent of the day-to-day government operations. The Federal Reserve controls two things. Most people think the Federal Reserve controls interest rates. That's incorrect. The Federal Reserve controls something called the federal funds target rate. And the federal funds target rate is the interbank lending rate between the Federal Reserve and the biggest banks in the US. Now, it's very correlated to interest rates. And so if you're going to say that the Fed controls interest rates, it's mostly true, but not totally true. The second thing they control, which most people don't ever talk about, is the money supply. And if you don't have a background in economics, I'm going to use an analogy. I think this is a helpful analogy. The analogy is oil in your engine and the engine itself. You see, interest rates are like oil to your engine. The more oil you have in the engine, the more lubricant there is, the easier it flows, the less friction there is on the internal combustible parts of the engine. And so, money supply, in other words, the amount of liquidity, the amount of money that the Fed pumps into the economy, is kind of like the horsepower of your engine. The greater the money supply, the larger the engine. Now, you can't run an engine without oil, and if you have oil, it doesn't really not really valuable without the engine. So obviously, you have to have both. And if you understand both of these concepts, you can really be very clear on what happened in the last decade of multifamily. In the two blue circles, this is, by the way, a graph going from 2005 to today of the federal funds target rate, which is the interbank lending rate the Fed uses. The two blue circles show the big interest rate movements. That's basically like the Fed either put more oil into the engine, or when they cut the rate, they took oil out of the engine to snuff out inflation. Now, what most people don't talk about is quantitative easing. And QE, or quantitative easing, is pumping a bunch of money, the money supply. It's increasing the money supply in the economy. It's effectively making the engine larger. And when you make the engine larger, you increase the horsepower of the engine. So to understand how quantitative easing had a major impact on multifamily is it drove asset pricing up. Why? Well, when you look at what happens with quantitative easing or the printing of money, a lot of people think that we print money. Is that true? The answer is no, that's not true. We don't actually print money. We borrow it. And the way that we borrow money, the way that it impacts multifamily investing is we sell treasury bonds. The Federal Reserve buys up treasury bonds that the US Treasury sells. And so that's how we actually borrow money. We don't really print it, we borrow it. And when you look at what happened in borrowing, and this is a graph published by pgpf.org, a bunch of data went into this graph, and it basically is a visual representation of how much money we borrowed going all the way back to World War II. So World War II, to fund World War II, we drove up the borrowing. We borrowed more money than the country actually produced in output. We crossed a 100% debt to GDP ratio. Any country that crosses the 100% debt to GDP ratio, that's typically a very bad thing. Well, what happened with quantitative easing in the 2008, 9, 10, 11, all the way up through roughly 2015 is that we unleashed an unprecedented borrowing through the Federal Reserve. We basically had the Treasury sell bonds. The Fed bought them up. That's increasing this liquidity. And we also engaged in a second round of quantitative easing as a result of COVID. And for the first time ever in the history of the United States, we are at 108% borrowing or debt to GDP ratio. Okay, so that really just, you got to understand the background of the money supply and how it affects multifamily, because because you're going to ask yourself, well, how can we borrow all this money? Well, what has to happen is politicians have to vote. And typically we get about one increase of the debt ceiling every year. If you go back through 2012, I put a graph on the slide that shows the votes when Congress and the Senate vote to increase the debt ceiling. We did it back in 2013. We voted to increase the debt ceiling again in 2015. We did it again 2016, and we have been increasing the debt ceiling through voting, which basically means we've legislatively allowed the country to borrow more and more money. And that debt ceiling, I put a little graph up there, debt out the wazoo going forward, because you can't really make the case that this borrowing is going to be allowed to continue. We did it as a result of the Great Recession, but the reason why we know it can't continue is because what it does to the US dollar. The US dollar, when you control for inflation, when you account for inflation, the US dollar has lost 93% of its purchasing power in the last 100 years. Now, that's when you control for inflation. That's when you dollar adjust average the inflation dollars. So when you pump all this fake money into the economy, it drives the value of the dollar down. Now, what does that mean for us? That means that the last decade of multifamily investing was really what I'm going to call the decade of appreciation. And multifamily assets appreciated dramatically for two reasons. One, large scale, unprecedented borrowing through quantitative easing by the Federal Reserve, which drove asset prices up because the dollar became devalued due to inflation. And number two, interest rate cuts. So that basically gives you a picture of what happened in the last decade. Meaning your grandma could have made money in multifamily without really breaking too much of a sweat. Now, I don't want to disrespect any people on here who've obviously put a lot of time and effort and money into multifamily. I'm just saying that there was a fairly significant tailwind from multifamily in the last decade. And another reason why we know it can't continue this way is what's happened with the 10-year Treasury. The 10-year Treasury is the cost of borrowing. So most loans that you're going to get from a bank, guys like Clay Allen, who I saw on the call here, Clay's going to go out and get you a great loan, and it's going to be indexed probably very closely to the 10-year Treasury in some way, shape, or form. The 10-year Treasury has gone down, 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 down since the mid-1970s. In fact, we're effectively at 0% today. It's not quite zero, but it's very close on the 10-year Treasury. I think it's about 0.7%. So you can't look at this graph and say interest rates are going to go down. They have to go up at some point in the future. So that's another reason why the next decade is going to be very different in multifamily investing, because we can't sustain the borrowing and we can't sustain the same interest rates. So that brings up the question, well, what's going to be different in the next decade? If borrowing wasn't bad enough, how are wages going to be impacted? I pulled out a graph from the Center of Budget and Policy Priorities. This basically looks at real wages over the last decade. It actually goes back to 2001. The orange line is median rents that are adjusted for inflation, and the blue line is our median incomes. The interesting part of what happened in the last decade is that rents grew 26 times more than income did when you adjust for inflation. Wrap your head around that for a second. I'm going to say it again. Rents grew 26 times faster than income did. Why? Because of large scale quantitative easing, borrowing, and slashing of interest rates. So this just supports my argument that we're going to make money in a different way in the next decade. And part of that's going to come from the fact that because income hasn't grown at the same speed as rents have, people have less money to save. And when people save less money, that means they have less of a down payment, and that creates what's called the rent trap. It means it puts the handcuffs, the rental handcuffs, around people, and it forces them, even when they want to buy, it forces them to stay in this proverbial rental trap, which is obviously good for the people on this call because that drives up occupancy. That means more demand. So we have to really agree at some point, in our investing career that just like most things in life, things ain't going to be the same in the next decade. Multifamily investors are likely going to make money in a new way. And the next decade is going to be the decade not of appreciation, but the decade of what I call demo economics in multifamily. So everyone pretty much knows on this call that real estate is a localized business, right? You've heard the phrase location, 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 right? You've probably heard that, right? Well, why do they say that? What most people don't ask is why is that true? And the reason why that's true is because of a formula: economics times demographics creates the returns that are very localized in multifamily. If you don't understand how this is going to affect you in the next decade, you might likely invest in the wrong deal. You might likely spend time underwriting a deal you shouldn't. So now that kind of gets us back to, we talked about economics. Let's go one level deeper and let's talk about microeconomics, because that's really what I want to really focus on for the people in this call. I want to focus on microeconomics, and I really want to really give you some examples about demographics. Okay, so the most important microeconomic factors in the next decade for multifamily investors, there's going to be one of two. So Carlos, I'm going to take a vote here. I'm going to take a poll. Which of the two factors do you think are going to be the most important microeconomic factors for multifamily investors in the next decade? Is it going to be cap rate? That's option A. Or is it going to be population growth? So Carlos, if you can just make sure we're dropping our votes in the chat there, and if we have any votes, what are we seeing in the chat there? You can either vote cap rate's going to be the most important in the next decade, or population growth. What do you think it's going to be?
I see some population growth coming in.
Okay.
Mostly population growth here.
All right, great. All right, and of course, I'm going to tell you that it's going to be neither. Right, you're probably sensing the pattern here. It's a little bit of a trick question. It's going to be neither. In fact, job growth is going to be significantly more important in the next decade than the last decade. Job growth is really, because of the post-COVID-19 era, I'm going to tell you that people move to jobs. By and large, jobs don't move to people. And I've created what I like to call the mailbox money continuum. So on the right-hand side of the screen over here, you see jobs are created. Companies move from California to Florida, or they move from California to DFW, or they move from Manhattan or New York City down to, Orlando. And that brings along, by and large, high-paying jobs. For every $100,000 salary job, it typically creates two $35,000 to $45,000 a year jobs. So that's what then that population moves for those jobs. So once that population moves, well, guess what happens with those $40,000 a year earners? They rent apartments. And so that drives up demand. And when demand goes up, supply of apartments goes down for units. That drives up the rent rates. And of course, it's a very happy cycle for us as investors. Now, a big concern that I have when I just talk to people, and when I'm out on the road doing these speaking events, is a lot of times they don't back up or they don't fact check an investment summary or an offering memorandum or some data before they go and invest in a deal. So I'm going to give you just some tools here that you can use in your own investing career to measure some of these microeconomic examples. So on your screen, and you can take a screenshot of this if you'd like, this is the Bureau of Labor Statistics website. The U.S. Bureau of Labor Statistics pumps hundreds of millions of dollars into this site every year, and it's funded by the government. And you can just go to bls.gov. On the right-hand side, you see that little search box. You can type in the search box this phrase right here, economy at a glance, and then space, and then your city. So if you go to bls.gov and you type economy at a glance space Tampa, you get this output down here. Now, why is this output important? Because in each economy at a glance output, it has a line on it of employment. And Carlos, do you see that little green it looks like a graph right there where my cursor is? See that little green graph right there? You can click that little graph and you can download an Excel file for the job growth data for every month over the last 12 months. So right there, before you even spend time underwriting it, before you even spend time getting on a conference call or doing a webinar, what I would suggest to you is measure this extremely important microeconomic factor by going to the BLS website, downloading the employment data for that city where you're considering investing, and do a little bit of computation. Now, jobs drive per capita income, and they're very closely related to one another. So you want to verify that the population per capita income in your property census tract has an average monthly income, has an average income that's about 70% higher than the average rent. So if you take the average income for an area, you multiply by 30%, then that should be a little bit either equal to or greater than the average rent. And Carlos, we're going to do an example about this in just a few minutes. I hear some noise in the background, so if you're not muted, if you wouldn't mind muting your background, that'd be great. Now, I'm going to put a graph in here. I'm going to talk about it just a little bit. I wrote a book about Florida multifamily investing after I interviewed a billionaire who made his money in Florida multifamily. I interviewed a couple centimillionaires, guys who made $100 million in Florida multifamily, and I asked them a bunch of questions. And as I dug into the importance of job growth from interviewing these guys, I went to the BLS website and I sucked out all the job growth data for like 20 different cities, and I plotted a few of them on this graph. I'm going to spend a minute just interpreting the graph for you, again, just to give you some more insight into this extremely important microeconomic factor called job growth. This goes back to 2010, and it shows a couple key cities here, and it plots the average annual job growth by city. Now, the magic number that you want to be above if you're going to invest in a city as an LP or GP is typically going to be that 2% annual job growth annually. Now, ideally, you'd go back to the last, and I see a wrong number here on my chart, I should say 2018 down there, but not 2014. But you're going to want to go back to at least the last 2 years. And Tampa, Dallas, obviously this is 2019 data. I don't have 2020 yet. It's going to be different for 2020 because of COVID. But this would give you just a high-level insight. This shows you that Houston is under 2%. It shows you Detroit is way under 2%. It just gives you some insight into how you would measure it and what it looks like when you plot it. Now, you can't forget, though, demographics when you're talking about job growth, because the jobs due to COVID are going to flow to cities in a very different way than they flowed in the last decade. 2020 to 2030 is going to see population and job growth in ways we haven't seen yet. And so to measure your city using a tool like this is going to be important. The other thing you got to understand is homeownership is dead. Well, I'll say it's dying. I pulled a graph from the Urban Institute Decennial Census where they measure the percentage of homeowners by decade. If you go back to 1990, 35% of every American rented a home. By 2020, by the year 2000, that went down. During the start of the Great Recession, 2020 went up, and over the last 10 years, we've seen a 2% jump, and we're going to see another 2% jump in renters. Renters are growing; they're becoming a larger proportion of the of all Americans in terms of home ownership. When you drill down and look at the graph, actually, we've had a pretty significant drop in home ownership from starting in 2005. It's going up a little bit, but we're going to see another reduction in home ownership, and I'm going to show you some data just to prove it to you. This is from the National Multifamily Housing Council. They did a big study, and the net of this is over the next decade, because of the dream of home ownership is dying, because the very important demographics that we're going to be talking about are largely going to be more choosing to rent than own. We need roughly 328,000 units delivered every year over the next 10 years to meet the apartment demand in America. Every year for the next 10 years, we need to deliver 328,000 units. If you look at the last 8 years, we've delivered roughly 243,000. So we're at about a 30% shortfall. And that's on an annual basis. And when you combine them and they stack over time, it's a little bit more of an exponential curve. I'm hearing some feedback. If you wouldn't mind muting yourself if you got your audio on. So you when you're looking at economics and demographics, the next decade are really going to be centered around not only microeconomics, but who. I find that a lot of people don't talk about who the renters are going to be and where they're going to come from. The renters are significantly changing. The renter base will change more in the next 10 years than it's changed in the last 60. And I'm going to prove that to you by showing you that there are 5 cohorts of renters that are going to be the 5 most important cohorts. These are demographic changes, what I'm going to call avatars of renters for the next 10 years. We have immigrants are going to be an important one. Down here, minorities is going to be an important one. Boomers are going to be an important one. Generational Y, and down here, millennials. I'm going to quickly go through these because I do want to save some time for Q&A after we do our example. But you might want to take some notes on these because as you're thinking about your own investing career, you're going to want to get smart about these 5 cohorts. These are the 5 that are going to rent your units. Immigrants are probably the most interesting. Got a lot of political debate around this topic. I want to set aside the political debate and I want to look at the data. If you look at the last 5 years, now I could only find data going back last 5 years. Over the last 5 years, the orange line shows us that the majority of population growth in the US came from babies being born to US citizens. In other words, it was organic, it was natural growth. However, over the next 10 years, because people are having kids later and the birth rate is declining, that is going to change. International migration, I'm talking people from other countries moving to the US, is going to drive a significant increase in population. Why is that important to us? Well, it ain't no surprise that immigrants, when they move to the US, what do? They rent an apartment. And we're talking about 1 million new people every year moving to the US. Now, this is before the election. This is before Biden got elected. So I'm going to come back to President-elect Biden in just a second. But that's about 2,700 new people every day moving to the US. And of those 2,700 people every day, a large portion of them will rent. They will not own. And I find it helpful when you look at this from a visual standpoint, you kind of get a better sense for how population change has been happening and what's going to happen over the next decade. So I'm going to orient you to this map very quickly. The dark, like the black areas of the map, that's very, very good. That represents the highest increase in population. The red and I guess that's like, what is that, sienna, and I don't know, like dark brown, that's very bad. That means people are leaving those areas. So I just took the time to draw some clustered circles around the biggest winners in the population gain. It's not a secret that basically the whole state of Florida has some of the highest population growth in America. Roughly 800 people a day are moving to Florida. Those are pre-COVID numbers. It's higher now. Dallas, Fort Worth, San Antonio, Houston. I think this is like Denver. We got some oil because of the oil work up in North Dakota, Utah. So when you're looking at this, basically we're just seeing a massive shift of people leaving New England and going to Florida, and people leaving California and going to Texas. I mean, that's effectively at a very high level. That's what's happening. And that's not probably surprising to a lot of people on this call, but what's probably going to be surprising is who the heck is actually moving? Well, to understand that, let's put the current American election into context. Legally, the election is still not declared a winner yet, interestingly enough, but 99.9% chance that Mr. Biden will be sworn in next month. I'm going to tell you why that's a very, very good thing for multifamily investors. Whether you're a Democrat, a Republican, an anarchist, a communist, I don't care. What I care about are the returns in multifamily. And Mr. Biden's agenda, and he's been very specific about this, he's very, very favorable toward immigration. We're going to have an opening of the U.S. borders. President Trump effectively reversed that. He reversed Obama's policy on immigration and he closed the U.S. border. Well, when you open up the U.S. border, guess what's going to happen? It's going to accelerate the immigration of international people moving to the country. And guess what? Those are going to be renters. And so who are the renters going to be? Well, the other part of it is looking at it for minorities. And this is not a racial discussion. This is not Mike being, a racist about who's going to rent. I just want to look at the data and help you understand that when you think of your property from an asset management standpoint or from a property management standpoint, you better understand the massive demographic shifts, because your marketing and your literature and the stuff that you put in front of these prospects has got to reflect the demographic changes in the renters. By the 2030, Hispanics will be the largest proportion of minorities in the U.S. That will be followed by Asians, and that will be followed by African Americans. And racial diversity is going to be a much more important concept in the next decade compared to the last decade. In other words, the marketing that you're using, your PM is using, the tenant mix, it's just human beings. We want people, renters want to rent around people that look like them. I mean, there's just no other way to say it. And I'm going to give you a great example about that. I mean, my wife Trisha. I mean, when her parents moved from Trinidad and went to the Bronx, went to Brooklyn. I mean, they rented a house. They rented a house for a really long time. That was a black family that moved to the United States, went to New York, and they rented a place for a very long time. So not only are we going to see immigrants moving from other countries, they're going to be renting. We're going to see that Hispanics, Asians, and Blacks are going to be the biggest cohort. Now, if you're already multifamily, probably not a big surprise. My point is your marketing materials and stuff needs to be bilingual. It doesn't even matter if it's a B or C asset. If you're not putting all your stuff in Spanish, you're probably doing yourself a disservice. Boomers are the third demographic shift that's going to happen. A lot of people have already heard this, but you probably don't realize how big it is. Boomers are right now, 10,000 baby boomers are retiring every day in America. That's not annually, that's not monthly, that's daily. We're talking 10,000 people every day retiring. When they retire, they're selling their McMansions, they're selling their houses because they're sick and tired of maintaining that thing, and many of them are moving into higher end A and B assets. So for those of you in the call that like to invest in A assets or even B plus, this is good news for you because it's driving up demand from a population that has liquidity, from a population that is going to choose to rent rather than need to rent. It's what I like to call the Club Med phenomenon. What you're going to see over the next decade are value-added opportunities where you're going to see entire apartment complexes that can have joint ventures and affiliate relationships with hospitals where you can set up a shuttle that'll go twice a day to the local medical mall from the apartment. You'll see value-added opportunities where you can create a exam room maybe on site in the multifamily complex, maybe off the fitness center, and you can have a dock in a box, rent the unit, rent the place down there. It's going to take a bunch of different forms. I'm just giving you some ideas of some possibilities, but the Club Med phenomenon is going to be pretty important, and boomers will rent. Now, Generation Y, if we're going to probably say who's the most important demographic change, it's probably going to be Generation Y. Generation Y are the people that are a little bit older than millennials. So they were born like in that roughly late 70s to like mid 80s or like late 80s. And they are older than millennials. And the importance of generational Y is that for them, customer loyalty is dead. It has been dead because they have been trained to believe social media and allow it to influence their buying behaviors. In fact, it's what economists refer to as the attention economy. The war for renters in the next decade is completely going to be waged, well, not completely, but largely going to be waged on social media. Property management companies, I'm convinced, because I've mystery shopped a lot of them in the last few months, they have not gotten on board with this yet. So if you're a property management company, or if you do direct investments, if you don't have a machine on social media that has Blacks, Asians, and Hispanics as part of your ads, and is bilingual and is creating content that matches this age demographic, you're probably falling short. Now, speaking of Generation Y, the National Multifamily Housing Council did a survey. You might find this interesting. Carlos, we're going to do another vote. We're going to take another poll. They surveyed 272,000 generational Y renters, the largest rental demographic for everybody in this call. And they said, tell us, please, rank order the top 5 most important amenities in your property. When you go make a renting decision, rank order the top 5 most important amenities. So I'd like for everybody to vote. Now, this is completely truthful. I took it right out of the survey, so I'm not manipulating this. I'm going to reveal to you what they voted number 1, but I want everybody to vote first. Drop it in the chat of those 5: pool, fitness center, in-unit washer dryer, reliable cell reception, and parking. Which one do you think Generational Y voted as the single most important amenity in for them when they go to rent? Carlos, are we getting some votes here? Just drop in the chat. I'd like you to vote of those 5. Which one do you think is the most important to Generational Y? Parking, washer and dryer in the unit, cell phone reception, fitness center, pool. All right, so first, the least important was the pool. That was ranked the bottom amenity. The second least important was parking. Middle of the road, the third most important was in-unit washer and dryer. The second most important was the fitness center, and it wasn't even close. It was like 68% of Generational Y people said, my number 1 decision when I go to rent an apartment is reliable cell and internet reception. Right. Now, this is important because if you don't have a relationship with, like, say, a contract service where you're joint venturing or have an affiliate commission with the cable internet provider and having a technician come on site, and you could offer a little $30 little upcharge to a new tenant that says, hey, Bob, glad you're renting the unit. Just want to let you know, if you'd like, we can bring in the technician who will do a internet audit, a wireless audit on your unit, and then he'll program your router for you and switch the channel and do all that stuff to have your reliable internet. Or if you want to do it yourself, here's the 1-pager best practice, and you can program yourself. That's an example of a value-add opportunity that would be relevant to a Generational Y, and I bet there's probably not 2 GPs on the planet that are doing that. And so this demographic shift, very, very, very important. Now, millennials are the ones everybody talks about. And I pulled a graph, and this is the last cohort, the last demographic change we're going to talk about. Millennials have a problem. Tuition costs have risen 5 times faster than wages over the last 20 years. Millennials have taken on a bunch of debt that has suppressed their desire to buy, that has lengthened their time. They're getting married older, they're having kids later. And so millennials really are, they're not as important as Generation Y because they're a smaller cohort, but they're going to behave very similar to Generation Y. So where does all this take us? Let's put an action plan in place for the LPs and the GPs on this call. And I'm going to go through a case study so we can take the learning of this presentation and we can implement it right now today, and we can help make money for our investing career. Okay, so the action plan looks like this. When you make a decision to LP or GP on a property, before you underwrite it, you're going to want to pull the job growth statistics, and you're going to pull them out of the Bureau of Labor Statistics database. I gave you the website, bls.gov. And you're going to want to see somewhere in most major metro areas, somewhere above a 2% annual job growth. All right. Now, you're also going to want to look at monthly income, because if your average monthly rents need to hit $850 for a 2-bedroom, 1-bath, and the average incomes for the area are, say, $1,000, well, obviously, you're not going to be able to fill those units, and you're going to have a significantly higher vacancy than you are going to want to have because the local incomes don't support the rent rates. Also, racial diversity is also going to be something I don't think it's talked about enough. I think it's something you at least need to look at and measure. If you have 98% Hispanics renting your property, and you're marketing it to African Americans and Caucasians, you're going to have problems filling it. That's just the way the world works. This is fact. This is not me ingesting, any kind of racial dialogue into the conversation. So, also, I would encourage you to request to review the marketing materials from the PM before you make any investments. Mystery shop the PMs on the properties. Are they baking in some of these Is it bilingual? Are there ads on Facebook and LinkedIn, or excuse me, Facebook and apartments.com? Do they have reasonable marketing materials that reflect some of the things you've learned in this presentation? So what I want to do now, Carlos, is I want to go on a field trip. Okay, we're going to do a case study, and then after the case study, we'll wrap up, and then we'll go through, we'll give everybody their bonus gifts, and then we'll move into Q&A. Okay, let's go on a field trip. Okay, because I like Florida, and I live in Florida, we're going to Orlando. All right, I pulled this deal off of LoopNet yesterday. The address, if you want to look it up, is 701 South Ivy Lane in Orlando. It's 189 units, C-class property, broker listing it for 17.5 million. And I'm going to just go over there really quickly. If you'll just bear with me just a second. So I've got the property pulled up right here on LoopNet, and it's got 105 2-1s, it's got 33 1-1s. So because it's in Orlando, obviously, I mean, before you even look at a spreadsheet, before you look at any underwriting, before you spend any time going to a webinar, you're going to want to measure the job growth for Orlando. Now, turns out I already did. I pulled the BLS. I went to the BLS website. I pulled up the Orlando MSA. I went to the employment line. I clicked the graph. I came down here. I downloaded the Excel data, and I very quickly did the math. And it turns out over the last 2 years, Orlando has had roughly about close to a 3% annual job growth. Now that's changed since COVID, but we don't have 2020 data yet, so I'm just going to use 2018 and 2019 data. So from a microeconomic standpoint, this property right now passes the test. And if you don't have to use Excel, by the way, you could just plug in a percent change calculation into your iPhone and pull the data out. And by the way, for anybody who wants to get a copy of these slides, I'll give you a way to do that here when we're done. And so you can hit these bit.ly links and go right to the websites that we've just talked about. So right now, if I was going to make an investing decision on this property, for me, if I'm an LP, if I'm a KP, I'm thinking, as of right now, it passes the sniff test. Orlando has decent job growth. In fact, even as a result of COVID, Disney has announced about 30,000 layoffs, but we're still getting somewhat of a reasonable job flow growth on the technology side. So it has dampened that effect a little bit. Now, the next thing we need to look at are some demographics. And this is a phenomenon that I'm going to call the census block group phenomenon. Here is where a lot of investors, even experienced GPs, guys I interviewed for the book I wrote, I realized make mistakes. When you go to make an investment, obviously that's a city level data decision. See, city level data is not actually very good when you're making an investment decision because real estate is hyper local. And so the United States government, particularly the census group, publishes something called census block group data. That data is where the Census Department slices up the United States into 229,000 different census block groups. See, if you could actually measure your census block group where your property is located, now you're measuring the data at a much smaller data set. See, if you were just measuring Orlando looks good, but we don't know anything about that specific census block group. Now, if you can see the picture there on the right-hand side of the screen, the picture here, this is a picture of a census block group data set. Census block groups are typically 1 to 5 blocks, can be a couple city blocks, might be at just a couple hundred feet. It varies. The U.S. Census Bureau has different methodologies. So I'm going to encourage you to actually go and look at the income and racial diversity at the census block group level. See, if we could do that, then we can actually make a very well-informed decision on demographics if it's a place where we would want to go look. So let's first go look at average income. So average income is something that obviously from a demographic and an economic standpoint, we would want to look at. So let's go look at Orlando. And what I've done before we got on the call is I went to Google Maps and I put in the address for this property. Now, when you go look at Google Maps and you zoom out, you kind of get a sense for where this is in Orlando. For those of you who don't know the Orlando market, it's west of I-4, it's south of I-50, and it's right next to this lake. And I'm blind, I forget what this lake is called. So now that we know where it is, let's go to city-data.com. You probably want to write that down, city-data.com. And I pulled up the Orlando MSA. And by the way, I scrolled down. When you come to this website, it's going to look like this. I want you to scroll down to the interactive map. This map sucks in census block group data. That is incredibly important for you as an investor because this is the secret weapon you can use. You don't even need a spreadsheet for this. You can go look at the census block group economic and demographic characteristics of where your property that you're considering investing in and measure it against these factors and make a very quick, in 3 minutes, make a very quick thumbs up or thumbs down decision. So I'm going to scroll down here to the map. I'm going to click this drop down arrow. I'm going to click medium household income. And I know I did this before we started because I didn't want to waste time, but I clicked on the census block group where this property is located. Okay, so the downside to this tool is you can't just type in an address very easily. You can only search at the city level. And so I already clicked on the census block group data, and I am going to pull in the demographic and economic data. Now, you might have to zoom in here a little bit, but you can see here, Carlos, if you can see this, it says medium household income for this census block group where this property is located. Can you see that, Carlos? It says 29,340. Can you see that?
I was gonna say, Mike, it's really, really small. So I just see the amount, but it's hard to read.
Okay.
Median household income of, I believe, 23 or 29,000.
29,340. Yeah. The medium contract rent is $654. So what you can do is you can go to the offering memorandum, or in this case, you can just go download the offering memorandum and see what pro forma rents that the broker or the syndicator put into the model for this. Because if they're putting in a $750 a month rent and the average contract rents are $654, is that good or bad? It means you're not getting, there's no way you're pushing 750 in this area. Well, I should not say no way. It's going to be highly unlikely. And the reason why I'm confident in that is this chunk of dirt right here, this is not more than probably a half a mile long by 2/10 of a mile wide. This is so hyper local. This data is so hyper local. Now, the next thing I want to do is I'm going to look at racial diversity. I'm going to look at race distributions. So I can come down here, I click on race distributions, I look at racial diversity, and I'm going to look at, I'd like to see roughly an even or a evenly distributed split between African Americans, Hispanics, and Caucasians. Okay, this property right now has 90% African American, it has 4% Hispanic, it has 3% Caucasian. So you can probably guess that it's going to be difficult getting Hispanics and Caucasians to rent this. That's going to drive an occupancy problem. So by just looking at demographics and taking into account what we learned, it doesn't take but 2 or 3 minutes to pull up this tool, go down to the census block data. And by the way, I don't have time to show you everything, but there is a massive amount of data that you can look at and measure down at the census block group level. So hopefully, Carlos, that is helpful for everybody. So this property would fail the average income test. It would fail the racial diversity test. So the reason why this property is on LoopNet, by the way, is because they can't sell this thing. That's why it's been on LoopNet for who knows how long, is because they showed it to all the savvy investors. They showed it to the people who probably went and measured some of the stuff, and they can't sell it. Crime rate, by the way. Crime rate is another data set If you want to look at crime, crime drives income out of a census group. You can actually scroll down to the bottom of this screen where it says crime rates by year. Now it only shows you by city. You can't break crime down to the census plot group, which is fine. What you definitely want to see is a reduction over time. Now the last year they have here is 2018, but you want to see a reduction over time. And ideally, you want to see something under 500 for the last year reported, which is 2018. And what this does, it takes per capita murders, rapes, robberies, burglaries, thefts, arson, and it indexes them into a number, and it just gives you like a number. The number is not very meaningful, but what is meaningful is that it's going down over time and it's under 500. So for those last three demographic, it fails them miserably. So that concludes my remarks. Hopefully you got a little bit of something out of this on demographics and microeconomics. I would like to now reward you. For those of you who stayed through here, I know I went kind of quickly, I want to reward you with a gift. And there's no strings attached. I'm not selling anything. You don't have to, this is not me selling a coaching program or a widget. I'm actually going to ship you a free gift to your house. And I guess I'll have to give you the bad news first. The bad news is you're going to have to take pretty quick action, because I'm going to start a timer here in a little bit. As soon as we go to Q&A, I'm going to start a timer. And you'll have 60 minutes to take action on this. And I'm going to give you the good news. The good news is I'm going to give everybody a free gift. And the free gift I'm going to give you is well, actually, before I get into that, the cost of getting this free gift is just give me a testimonial. We're always trying to collect testimonials from people, and I went kind of fast, but if you got anything out of this, if you felt like this was helpful or you learned something from this, I would really appreciate it if you would just give me a quick little testimonial. You can do a video testimonial, you can do a written testimonial. I don't care which one you do. I would just really appreciate that. I'm going to start the clock, and if you give me that testimonial in the next 60 minutes, I'm going to give you a free copy of my book. The book is entitled Endless, Effortless Monthly Cash Flow, How to Create Passive Income for Life from Florida Apartments While Living Anywhere in the World Without ever lifting a finger or talking to tenants. Now, it's not that I'm particularly like a really smart or an expert about investing in Florida multifamily. I have a skill for getting really rich people on the phone and interview them about how they made their money. And so I spent about 6 months, interviewed the richest people in Florida who made all their money or most of it in multifamily, and I wrote a book about it. And the book is written as a novel. It's not written as a textbook. It's actually written as a novel with a storyline in it, and so it's not boring. And I will ship you a free copy of the book. We're going to sell this book on Amazon for $25. The manuscript is done. It's in edit. It's going to come out next year. But I'll ship you a copy. All you would need to do is take care of a really small shipping charge for that, and I'll pay for the book, and I'll get that to you. If you submit a video testimonial, we're going to up the ante. For the very best video testimonial, we're going to give you a $100 Amazon gift card, and you'll get the book on top of that. So obviously, video testimonials are valuable to us because we are rolling out a new website in January, and we would love some video testimonials. So if you wouldn't mind giving a video testimonial, great. If you don't want to do that, that's cool too. Just give us a written one. And the very best video testimonial for the year is going to get a $100 Amazon gift card. And basically, we collect all the video testimonials over a 12-month period. We look at them all, and then we reward the winner, and we give them a $100 gift card. So if that's okay with you, Carlos, we are going to conclude here. I'm going to drop the link for the testimonial in the chat. So it's super easy. All you do is hit this link. I'm going to drop the link. If you can just hit that link, you got 60 minutes, Carlos. I'm going to start the clock for a 60-minute countdown, and then we're going to turn it over to you, and I'm going to go into Q&A. So we've got 60 minutes on the clock. Please, if you wouldn't mind, hit the link in the chat to provide your testimonial. You can either do a written or a video, and you've got 59 minutes left to submit that. Everybody who submits the testimonial in the next 59 minutes will be getting the free copy of the book, which I will ship to you. and the best video testimonial for the year gets the $100 gift card. Carlos,
Okay,
that, my
Mike.
friend, is it.
That was great. I personally got a lot of information out of it. I like the websites that you shared with us, the information, and how you find the demographics as far as the jobs coming in to the local area, both the macro and the microeconomics of the area, by using the Bureau of Labor and Statistics. I really like that. That was really cool. So we do have a question here, and well, we have several, but I'll be brief here. So when do you expect this data to be updated with the 2020 census data? And that was asked by Rudiger.
It's a great question. Normally, I think it comes out in, I think because they do what's called a, I'm blanking on the term. They do it every year. It's a mini census. The census that we all fill out is every 10 years, but they do a mini one by MSA every year. I think it comes out in March, but I saw a press release somewhere from the Census Bureau that due to COVID, it's slowed down. And so I don't think the 2020 data is going to be out in March. So I think it'll probably take a little bit later. So, but there's another way around that here's another way around that. Like I know in Orlando, I'm just going to talk Florida. It's probably going to be the same across most of the country. You can go to the economic development arm of the city. Every major city in America has an economic development group. These are people that get paid to bring jobs into the local economy. You can go to the website, fill out the contact sheet, and say, "Hey, can you give me the updated job growth data for 2020?" It might not be completely formalized done, but they can probably give you at least a draft or some color to the data, and I would be able to trust it because the economic development people get paid to put that data out. So that would be another way around that.
That's awesome. That's a great question. A great answer. Thank you, Mike. Okay. Any other questions? Anyone else have a question that they want to post for Mike today? Okay.
Looks like one of the questions is they can't figure out the link to the review. I'm sorry, I'm sending it to Carlos and not everybody. Well, that's why you can't see the link. I was sending you, Carlos, the link and not everybody else. So
okay, yeah.
Please hit this link here and fill out your testimony. I've got 57 minutes left. Anybody, I would really appreciate a testimonial, video or written. There's a little form there. You hit the link, you go to the form, take you 60 seconds and you're done.
Okay, but I just wanted to say, Mike, you also had something else that did you want to talk about the marine thing that you and I discussed?
Yes,
earlier?
Thank you. Yeah.
Please, yes.
Yeah. Some of you guys already know this. We've got a partnership with the Semper Fi Fund, and I because I was so short on time here, I didn't go into how much I normally would cover on it. So thank you, Carlos, for giving me a chance to talk about it. The Semper Fi Fund is a nonprofit that is headquartered out in Camp Pendleton, California, where the 1st Marine Division is located. And it is a nonprofit that takes combat disabled vets and puts them back to work through vocational rehabilitation and training and prosthetic help, psychiatric care, and they are the top rated organization, way better than Wounded Warrior. So I'm not poo-pooing Wounded Warrior, but Wounded Warrior has a very sophisticated marketing arm, and so that's why people know about them. Most people don't know about the Semper Fi Fund because almost all the money goes back to the vets, and they don't put any money into marketing. So I'm taking up that. That's my job. My job is to go out there and tell people about it. And so if you're ever looking for a charity, or you ever looking for an event and you need a charity to come beside you, my colleague Merkel, a female who's a wife of an Army Fulbright Colonel Marine, who's one of the directors over there, is a great person to partner with. And it's a great organization, and we're going to be with them for quite some time.
That's great, and I thank you so much for letting us know about that. I'm definitely always looking for a good charity, and I really believe in the cause. I personally am super grateful for your service, Mike, And for all Marines, I have a lot of LinkedIn colleagues and friends that are Marines, and I'm very grateful for your services. So thank you again. Appreciate that.
Yes, sir. Same. Got Joe on there. Joe over there too is a little younger than me. That makes me feel a little old, but he's a Marine too.
Awesome. Thank you, Joe. I really appreciate that from the heart. And so just if I could take a quick minute, I know I kind of went way over in the introduction, but I just want to say what I'm doing is I've been in real estate since 1999, originally started in Miami, Florida. So I do know the Florida market from head to toe. I still visit twice, 3 times a year sometimes. And so what I did back then was I bought 5 and 6 units on my own, by myself. And then I had an investor come up and say, listen, I like what you're doing. I like the properties that you've bought. So I'd like to buy one with you and see what happens. So we bought a 5 unit together. And after doing so, he liked the process. So we bought another 5 unit and a 6 unit. So we bought a total of 3 properties together, plus the 5 unit that I had. Then fast forward to 2008, moved over to Georgia. I've been, selling single family as a real estate agent. And I decided that, a couple years back that I wanted to go into multifamily. So I got this opportunity from Dan Hanford to be a co-organizer for his group. Hamad is actually part of the mastermind for this group as well. That's where we know each other from. Nice. And yeah, cool. And then so this group is very important to me. It's very dear to my heart. And the reason why is because basically because of Dan Hanford. I like what he does. He's always talking about know, like, and trust. Definitely someone you could know, like, and trust. And then he gave us this opportunity. And what I've learned, the process of this show was to give back to others. And I want others to learn as we're coming up and as we're investing in multifamily deals, I want others to come up with us. And I want to be able to invest with other investors and syndicate deals. That's basically what I'm doing. I've done JVs and I'm looking to syndicate. And as far as how many units, from 100 to 250, the price range there would probably be more from the 10 to 15 or 20 mil range. But, it's a big number, but I'm not afraid of the numbers. I do have some loan guarantors. And, if I could help you guys in any way in introducing to loan guarantors, it would be my pleasure to do so. I would highly recommend, and Joe, I just haven't had a chance to get to it, but I'm definitely going to accept your colleague request for sure. I would highly recommend to find me on LinkedIn because I do have great connections. Yeah, I'm an open book. So anyone that you see on there, please help yourself, introduce yourself, let them know that you met, through me, that connection. And by all means, I definitely highly recommend everyone. 99% of the people that I have on LinkedIn are investors or someone in the multifamily space. There might be 1 or 2% of like marketers or some kind of agents or property managers, if you will. Other than that, everybody's an investor. So that being said, I'm going to go ahead and wrap up this show. Just want to thank everyone for being here tonight. We did have some people that send me messages they had to cut off early, but we're going to meet up every first Monday of the month, except when that lands on a holiday. In that case, we'll move it to a Tuesday. But I look forward to seeing you guys in future meetups. We do have someone coming. I mean, we're backed up all the way to April. So I hope that you guys will join us and participate with us. And I hope to invest with you guys in the future because I have a feeling we're going to be doing some business together. So thank you guys for your time. And that being said, this has been Carlos D. Reynoso with awesome presenter of Dr. Mike Lorence. Speaking of our demographics, the new oil. I am super honored to be part of this panel with everyone who's been here today. Thank you guys so much for showing up. This has been Multifamily Meetup Mondays with Carlos D. Reynoso signing off. Thank you and have yourself a wonderful evening. Take care, guys.